My name is Ian Angel, and I'm an emeritus professor at the London School of Economics. The content of this video was originally a talk about anti-money laundering that I gave to the Financial Services Club of the City of London in December 2020. I've altered it so that it is now suitable for a more general audience, most of whom are probably unaware of the sheer scale of the problem. Money laundering is the illegal process of concealing the origins of the financial proceeds of crime through a complex sequence of bank transfers or commercial transactions. It is estimated that up to $2 trillion is laundered every year. Anyone who has opened a bank account has been inconvenienced by the Know Your Customer, the KYC rules, put in place to stop laundering. This is just a small part of an enormous worldwide anti-money laundering AML effort. Over $100 billion is spent annually to combat laundering, but only a tiny fraction of that sum is ever returned as asset recovery. As a business model, the only word to describe AML is absurd. And I am a student of the absurd. I see absurdities everywhere, but particularly in anti-money laundering. To make things worse, these absurdities in AML are becoming increasingly computerized. From my perspective, it all resembles the Mad Hatter's Tea Party. Perhaps I'm wrong. Hopefully somebody watching this video and who works at the coalface will put me straight. There are 5 actors involved: the launderers, the banks and other financial institutions, the police and prosecutors, the courts, and last but not least, the regulators. These are the national, like each country's FIU, its Financial Intelligence Unit, and the international, like the Financial Action Task Force, the FATF, and even the OECD and United Nations. Now, the courts are reasonably transparent. Their decisions and the reasons for making them are mostly on the record. Not that there have been many successful money laundering cases. With a few exceptions, the prosecutors have had little input. One notable exception came in July 2020 in Osnabrück in Germany, where prosecutors instigated criminal proceedings against officers of the local Financial Intelligence Unit for obstruction of justice. And what was the regulators' crime? They had failed to deal with the huge backlog of suspicious activity reports. You couldn't make this up. It's quite absurd. As for the money launderers, all but the most incompetent will study the various AML systems that confront them and successfully bypass any hurdles. The banks and the regulators aren't as savvy. When a launderer is caught, usually because someone has informed on them, and hardly ever through the efforts of AML, only the most superficial lessons are learned. And how do we measure the success or otherwise of those AML efforts? If the measure is the number of successful prosecutions or the assets recovered, then clearly AML is an unmitigated failure. However, if the measure is 1, how much the banks are being fined, or 2, the sums of money being spent on AML, or 3, the number of people employed in AML, or 4, the number of suspicious activity transactions, SARS, submitted, then it is a rip-roaring success. The number of man-hours expended on anti-money laundering is quite staggering. It's easy to see why the promises of efficiency through technology are so appealing to those who bear the costs. AML compliance keeps growing and growing. It's a job creation scheme for bureaucrats and a happy hunting ground for technology salesmen, because it's a huge investment. Sadly, no one seems to accept that computerizing failure will always lead to failure. quite absurd. Although, in my mind, the most absurd situation is the relationship between the regulators and the banks. No rational person can look at this without laughing. Take the Financial Action Task Force, founded by the G7 in 1989. Their documentation goes on and on about how being fined by the regulators is a huge reputational risk for financial institutions. It was Stalin who so wisely commented, "One death is a tragedy, a million deaths is a statistic. One non-compliance fine is a tragedy, 1,000 fines is the price of doing business." How long before every single bank has been fined, and many times over? It seems that compliance bureaucracy is unstoppable. To think that the FATF was supposed to dissolve itself after producing its 40 recommendations. A fat chance. Bureaucracies don't die. They don't even fade away like old soldiers. They just grow and grow. In fact, in the case of anti-money laundering, it's even worse. AML is far more than a bureaucracy. It's become an industry. Financial institutions up against a swarm of all-powerful regulators, and you can't fight City Hall. Dealing with bureaucracies is like trying to nail the jelly to the wall. Now, the first actions of bureaucracies in respect of costs are: 1. Pass as much of the work and costs as possible onto those being regulated, just like the taxman does with VAT. And 2. Levy fines to offset your own costs. This ever-expanding slime mold of compliance has to be paid for, mostly by the banks, in fines, in their burgeoning AML departments, and in buying technology. Unfortunately, many in the banking sector are from the pixie dust school of technology. You sprinkle technology on a problem and something wonderful will happen. Hence, I expect an even bigger investment in AML technology in future. Talk about the blind leading the blind. Meanwhile, the regulators are pushing the absurdity they proudly call the risk-based approach. To quote the FATF, a risk-based approach means that countries, competent authorities, and banks identify, assess, and understand the money laundering and terrorist financing risk to which they are exposed, and take the appropriate mitigation measures in accordance with the level of risk. What this actually means is that ultimately everyone will dump all responsibility onto the piggy in the middle, the banks. Banks have no option other than to look to technology as their only escape from this escalating money pit. Both sides, the banks and the regulators, are in denial over the ambiguity behind their notion of risk. Risk is not some absolute statistical thing. Risk is highly subjective. Each side sees it differently. For example, the regulators don't realize that from the bank's perspective, the biggest risk is not being caught helping launderers, but being fined. Then there's the fact that by reporting on clients, the banks risk losing those clients. If you look up my YouTube video from the link on this slide, you will see what I mean by risk and why the FATF interpretation of risk is not only confusing, it's absurd. Basically, all communication is asymmetric. Sender and receiver will understand each message differently. Regulators and banks do not understand each other, cannot understand each other. The trick is to ensure that the sender-receiver pair don't fall into the chaos of compounded misunderstanding. Now, this requires a continuous feedback stream. And yet, from their side, the banks swamp the regulators with false positive suspicious activity reports, while the regulators give little or no feedback on the value of reports. It's Speaking from a position of power, regulators feel they don't need to explain themselves. Behind the regulator's stance is the bureaucrat's golden rule. Ignorance of our rule is no excuse. The regulations and the regulators of AML go one step further. They say, we won't tell you our rules because then it's so much easier to fine you for non-compliance. One example is the failure of the regulators to explain how they set the level of fines. Added to the absurdity is the fallacy of the fictional individual, a crime that I am guilty of in this talk. I refer to a bank as it, an individual. Each bank is an agglomeration of people and procedures. Treating a bank as an individual is absurd. Money laundering could well be the result of combined actions of various employees, none of whom is aware that they are part of a clever laundering scheme. And then if laundering is uncovered, the question is always asked, which individual is responsible? Who is to blame? Then we have the numerous fines being levied on banks worldwide. Note, these are not for aiding and abetting laundering, because with so few successful prosecutions, there wouldn't be any fines. No, the fines are for failings in AML procedures. And how does bank management view these fines? Possibly as a tax on profits. I believe 1% seems to be the going rate, or more likely as the price of a peaceful life. With the scale of AML exploding, everyone is looking to technology to ease the burden. But what does AML technology actually do? Putting it simply, it profiles. It looks for suspicious patterns in the way money flows in and out of banks and links this to customers identified as being fishy. With today's software, at least the profiling patterns make sense to us humans. The patterns are usually known laundering techniques programmed into the software. However, artificial intelligence is invading AML. As with neural nets, software is often unable to externalize the patterns it uses in a way that we humans can understand. And since regulators are human, believe it or not, how can they make claims about non-compliance when they won't be able to analyze the procedures? And did I say regulators are human? Only until artificial intelligence finally invades the regulatory domain as well. The banks will have to respond with the three musketeers strategy, all for one and one for all. They will all use the same AML compliance software. So the regulators, human or automated, can't fine a single bank without fining them all. AI is already making inroads into the legal profession. Soon we will have a situation where there are no people involved. Everything will be done automatically, quickly, and hopefully at lower costs. The courts too could be automated. Authority for AML will then be completely handed over to an artificial intelligence in what is the ultimate absurdity. AML technology will have become judge, jury, and executioner. Of course, it won't make any difference. They'll catch no more launderers than they do today. It's quite absurd. But maybe then they'll do the right thing and scrap the lot.